Trade war. Countries waste no time in retaliating to Trump's tariffs. While Canada matches Trump's tariffs over two phases, China announces its second round on tariffs on US goods. The Nifty logs its longest losing streak in 29 years amid weak global cues and concerns around Trump's tariffs. Nifty Auto also hits 52-week low and emerges as the top sectoral laggard. Media index ends higher by over 2%. Reliance Industries receives a demand notice worth 24,522 crore rupees from the Ministry of Petroleum and Natural Gas. This is following a recent High Court ruling against Reliance and its partners over gas extraction in a deep water field located off the eastern coast. Spinner Varun Chakravarti strikes in his very first over and manages to dismiss Travis Head, who was on a costly boundary rampage. The champions teams meet again today in a knockout match as India plays Australia in the ICC Champions semi-final. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. For the next half hour, we're going to bring you the latest on markets as well as national and international news. So let's dive into it. March 4th, the day that Donald Trump promised the much debated, discussed 25% tariffs on China, Mexico and Canada would kick in. While Trump argues these tariffs will pressure the US's neighbors to crack down on fentanyl trafficking and illegal immigration, he has also made it clear that the broader aim is to eliminate trade imbalances and bring manufacturing back to America. The administration remains firm in its belief that tariffs are the best way to boost US industry and attract foreign investment. But with trade tensions soaring, will this move secure economic dominance or spark deeper global disruptions? When it comes to Indian business giants such as Tata, Chairman N. Chandrasekhar said the impact of tariffs will be short-lived as India is dominant. Meanwhile, market veteran Ajay Bagga also believes that retail investors must continue to buy.
टैरिफ्स का बात चल रहा है, चलते ही रहेगा. So we have, these are all short-term things that will happen.
Okay.
But I feel Tata Steel in India is predominantly serving most of the domestic market.
Sure. Okay.
And so export का बहुत कम है हमारा, और यूरोप में थोड़ा एक्सपोर्ट है. But लेकिन स्टील का प्राइस कैसा रहेगा अभी थोड़ा स्टेबल है, देखना पड़ेगा. So इसके लिए जो हमारा कंट्रोल पे है, लाइक प्रोडक्टिविटी एफिशिएंसी, उसमें ध्यान रखना चाहिए.
ठीक है.
नो पॉइंट इन टॉकिंग अबाउट व्हाट विल बी द प्राइस, व्हाट विल बी द टैरिफ. दैट जो होगा हम गवर्नमेंट के साथ बातचीत करेंगे और व्हाट एवर हेल्प गवर्नमेंट हैज़ टू प्रोवाइड, गवर्नमेंट विल प्रोवाइड, बट वी हैव टू बी एफिशिएंट.
For me, especially the retail audience who favor your channel, Neeraj, I would say every time is a buying time and you should regularly keep buying. Now, as far as the bottom of the market is concerned, mathematically we can prove that, okay, now the valuations are this, valuations are that. One, valuations is an art. It's not a science. We don't know if it will actually come at 9% or, as you said, it might be 7, it might be 11, it might be 15% earnings growth also. So we have to look at history. We have to then aggregate it company-wise and make a portfolio. I would say we are probably about a couple of months into the bottoming process. It will take time. It won't happen very rationally, very scientifically, that the market participants will realize that, say, the Nifty is now below its 10-year average trailing PE, and now let's start buying. That won't happen. Mostly the momentum on both sides, Neeraj, it takes the markets up or down. So there is an overshooting that happens. Right now, we might be in the overshooting. That we will know a year down the line that, yes, this was the time when the turn should have happened, but the market overshot and then it made a turn. But definitely, yes, it's not the September end market of all-time highs. Is it going down 10% more? I don't think so. I think there's a very little probability, unless there is some shooting war or some geopolitical big event comes in. I think overall, the tariffs of Trump will not have that big an impact on India. They might bring in recession in pockets of the world. So that issue remains. But overall, I think we have weathered it well and we are near to the bottom. Now, whether it happens this week or 2 months down the line, it's an art, it's not a science. And I would say these numbers just give you an idea that now it's looking good. Is it very compelling? I think right now people are really hurting, with the 94 lakh crores of valuations that have evaporated. It's tough to tell people to bring in chunks of money. I would say regular money over the next 6 months, keep investing, because first the bottom will form. Recovery will take time again.
So first, let's see what has been announced or what could be announced in the next couple of weeks. Firstly, it's the 25% tariff on all imports coming in from Mexico and China. Then there is a 10% additional tariff on China, which will take the cumulative tariffs on China in the last 1.5 months to 20%. Then there's a possibility of 25% tariff on steel and aluminum imports from all trade partners from March 12th. And then in April, there's a possibility of the reciprocal tariff coming in. Firstly, let's try and understand the impact of the tariffs that could come in the next couple of weeks and which Indian companies stand to either benefit or lose out of it. Firstly, coming on to the chemical companies like PI Industries, UPL and Jubilant Ingrevia. Now, these three companies stand to benefit because these three companies are manufacturers of the top 5 chemicals that are imported by US. So if there is any tariffs on China, then these three companies could stand to benefit. Now, when it comes to the auto ancillary space, it is a bit complicated. Companies like Samvardhana Motherson, Bharat Forge, Sona BLW, JK Tyre, Balkrishna Industries, Sundaram Fasteners and Timken India. All these companies have direct exposure to US, but the impact could be limited because most of them also have plants in US. But given the complex auto supply scenario that is there, an auto supply chain there could be an indirect impact on all these auto ancillary companies, because auto ancillary companies customers, that is the OEMs, have a high dependent on Mexico and China for manufacturing to serve the US market. All these companies, that is Ford, GM, Volkswagen Group, BMW, Mercedes, have manufacturing units in Mexico and Canada which serve the US market. So any tariff could lead to pricing pressure for this auto ancillaries as well. Now, when it comes to metal companies like Vedanta, Hindalco, Nalco, SAIL, JSW Steel and Tata Steel, no direct impact because we hardly import metals to the US market, so no direct impact. But again, this tariff imposition may have an impact on the steel and aluminum prices because of the changing demand supply scenario, so that could impact these companies. Also, the indirect impact could be on steel dumping coming in from China, South Korea and Vietnam in the Indian market, so that could impact the steel players as well. Now, apart from that, two companies that stand to benefit directly, JSW Steel, they have a 1.5 million ton capacity in Ohio, which contributes nearly 4.5% to the total revenue, and this stands to benefit if prices move higher. Then there is Hindalco. Now, for the Novelis unit, the impact is still not sure, given the fact that the company could benefit from higher aluminum prices, but on the flip side, the raw material prices could also move higher for the company. However, the company believes that they can be exempted, like something similar that happened last time as well. So currently, we do not have a clear view about what happens to Hindalco as a subsidiary, that is Novelis. Then there is one company, Cummins, that could stand to benefit because higher tariffs on Mexico may open up higher prospects of exports for Cummins India. Currently, exports is a very small portion for the company, but Cummins Mexico unit exports nearly $1.5 billion of components and diesel engines to the US market. And if there are tariffs, this or part of this exports could move to the Indian unit going forward. And lastly, it comes to the IT sector. Now, direct impact is very limited via nearshoring from Mexico and Canada, less than 5% of the supply, so not much of an impact, but still a list of companies that have direct exposure to the US market are Infosys, LTI Mindtree and HCL, which have a highest exposure, and companies that have the least exposure are KPIT Tech, Tata Tech and Tata Elxsi. So keep an eye out for these companies, given the fact that tariffs could come in the next couple of weeks.
Absolutely, a wait and watch approach is what we're hearing. And moving on, in a swift retaliation to these tariff hikes, China has not wasted any time in announcing additional import duties of up to 15% on a range of American agricultural and food products. Now, these new duties will take effect from March the 10th and will impact US exports like chicken, wheat, corn, soybeans, and more. Now, CGTN's Siwen Wang joins us with more details.
China has announced additional tariffs on a range of agricultural imports from the United States effective March 10th, and this is in retaliation to a hike in levies imposed by the Trump administration. China has announced additional 15% tariffs on chicken, wheat, corn, and cotton from the U.S. Additional 10% will be added to tariffs on sorghum, soybeans, pork, beef, aquatic products, fruits, vegetables, and dairy products. While the country's Commerce Ministry also announced that it will file a lawsuit at the World Trade Organization, or WTO, over the additional 10% tariffs the U.S. has imposed on China. Additionally, China has added 15 U.S. companies to its export control list, and this comes as China's political two-session season kicks off. And the country's top legislature, the National People's Congress, or NPC, held a press conference today. And to a question about the China-U.S. relations, the NPC spokesperson asserted that mutual benefits, or win-win cooperation, remained at the core of the relationship between the two countries. While he added that bilateral trade has increased over 200 times over the past 46 years of diplomatic ties, benefiting not only the two countries, but also contributing to global economic growth.
And it was a flat end to the markets today, with Nifty barely holding its ground over 22,000, and the benchmark also recorded losses for 10 days straight, which is its longest falling streak in 29 years. Auto emerged as the top sectoral laggard, but the media index ended over 2% in trade. My colleague Anushi now joining in with a roundup of all the action on Dalal Street today. Anushi, over to you.
Right. So now if we see, Nifty 50 has clocked in its 10th session, wherein it is ended the session with losses. It's in red again. Now, this is the longest daily losing run that we've seen in the last 29 years. Nifty, in fact, it fell for 10 sessions last in Jan. 1996 is what we are seeing. In terms of where the sectoral action is and where the stock-specific action was, Bajaj Auto and Hero MotoCorp, the top laggards in trade today. In fact, Bajaj Auto has ended in red for 7th consecutive session, while Hero MotoCorp, it's been 6 sessions now that it's ended in red. If you look at Nifty Auto, that it had hit a 52-week low today. And as mentioned, that top sectoral losers, Bajaj Auto and Hero Motor, were the contributors to this. Nifty IT was another pack wherein we had seen pressure in trade today. If you see, yesterday it had ended in green, but it again reversed those gains of yesterday and ended in red, which was again, if you see what had happened, it had lost its 7-day losing streak yesterday, but now again the index is back in red. Now coming to on the positive side, we have Nifty Media and Nifty PSU Bank, which emerged as the top sectoral gainers. In fact, Nifty Media had snapped its 3-day losing streak, ending the day with some gains, while Nifty PSU Bank snapped its 6-day losing day streak and ended with gains again. In terms of where the broader market action was, broader markets have held strength, outperforming the benchmark indices, wherein we'd seen some pressure. Nifty Midcap 150 had ended in green for the 2nd consecutive session, and in fact it recovered about 2% from the day's low as well. Some of the top Midcap 150 gainers include NLC India and Bharat Dynamics. In Nifty Small Cap 250, it snapped its 6-day losing streak and ended the day with gains, recovering about 3% from day's low. Small Cap 250 gainers include India Cements as well as something like a Concord Biotech. I also want to talk about some of the market cap movement which have taken place. Now, large cap stocks have gained around 4,058 crore in market cap today, while small cap stocks have gained around 43,000 crore in market cap today. And the top contributors in this include Concord Biotech and Jyoti CNC. So this is the overall market action that we are seeing in trade today.
Anushi, thank you so much for bringing us those updates, and some more information coming in. Reliance Industries has received a demand notice of 24,522 crore rupees from the Ministry of Petroleum and Natural Gas. Now, this follows a recent Delhi High Court ruling against Reliance and its partners over gas extraction in a deep water field off the eastern coast. Mihika joins in with more details on this.
So Reliance has received a $2.81 billion demand from the Ministry of Petroleum and Natural Gas. Now this demand notice is following a recent division bench ruling of the Delhi High Court, and this is regarding a dispute that started long back in 2014 between RIL and ONGC. These both companies had adjacent blocks, and ONGC claimed that Reliance migrated gas from ONGC's blocks and hence Reliance was liable to pay. Now when you look at the timeline, 2014, the dispute began when the government demanded $1.55 billion from RIL. In 2016, the government sent a notice to RIL and its partners British Petroleum and NECO. In 2018, an international arbitration tribunal ruled in favor of RIL, but in 2023, a single judge of the Delhi High Court dismissed the government's appeal, and now in 2025, the division bench of the Delhi High Court has overturned the single judge's ruling requiring RIL and its partners to pay $1.55 billion. And yesterday, Reliance has received a demand of $2.81 billion from the government, and the higher amount that has been demanded could be because of interest and penalties. Now, if liable to pay, then the $2.18 billion, which is roughly around 24,550 crores, translates to 31% of the last 12-month profitability that Reliance has seen. But Reliance has clarified, they say that the provisional demand is unsustainable. They're taking steps to challenge the judgment and do not expect any liability on this account. Separately, as per Bloomberg, RIL has also been penalized by the government after failing to set up a battery cell plant. Reliance New Energy Limited, which is a wholly owned subsidiary of RIL, was fined 125 crores back in 2022, and Reliance New Energy had won a bid for the battery cell manufacturing under the PLI schemes.
Thanks, Mihika, for those updates. Now, the Prime Minister has highlighted that shifts in the global economy and trade could be an opportunity for Indian companies to increase investments and capitalize on the world's demand for alternative supply chain hubs. During an online webinar themed MSME as an engine of growth, the Prime Minister also emphasized to business leaders that the world requires a reliable partner capable of producing high-quality products and ensuring consistent supply.
दुनिया को आज ऐसे भरोसेमंद पार्टनर की जरूरत है जहां से हाई क्वालिटी प्रोडक्ट्स निकले और सप्लाई रिलायबल हो। हमारा देश ये करने में सक्षम है। आप सब सामर्थ्यवान है। ये हमारे लिए बहुत बड़ा मौका है, बहुत बड़ी अपॉर्चुनिटी है। मैं चाहता हूं विश्व की इन अपेक्षाओं को हमारी इंडस्ट्री एक स्पेक्टेटर की तरह न देखे। हम दर्शक बनकर के नहीं रह सकते हैं। आपको इसमें अपनी भूमिका तलाशनी होगी, अपने लिए अवसरों को आगे बढ़ाकर तराशना होगा। पुराने समय की तुलना में आज ये कहीं आसान है। आज इन अवसरों के लिए देश के पास फ्रेंडली नीतियां हैं। आज सरकार इंडस्ट्री के साथ कंधे से कंधा मिलाकर खड़ी है।
And there's relief for former SEBI chief Madhvi Puri Buch and 3 whole-time members of SEBI as the Bombay High Court issued a stay on the FIR ordered by the Anti-Corruption Bureau. This FIR was based on allegations of irregularities in the case of listing of a firm called Cal's Refinery way back in '94. Earlier, the former SEBI chief and the others had challenged the order in the High Court, seeking that the case actually be quashed. My colleague Charu Singh has all of the details.
The single-judge bench of the Bombay High Court has just stayed the order of the Special Corruption Court of Mumbai that had ordered for an FIR to be registered against the former chairperson of Securities and Exchange Board of India, 3 WTMs, that is the whole-time members who are currently serving in the market regulator SEBI, as well as 2 BSE officials. Now, the court also orally observed that this was some sort of a mechanical order passed by the special court's judge without really going into the intricacies of the matter. The parties were represented in the following orders. The Solicitor General Tushar Mehta represented the serving WTMs, whereas Madhvi Puri Booch was represented by another senior advocate, and the petitioner Sapan Srivastava was representing himself in the court. The court gave him 4 weeks to give a reply to the arguments made by Booch, the WTMs and the BSc officials, and the matter is going to be taken up next after the completion of 4 weeks. The petitioner also alleged several irregularities during the listing of CAL's refinery by the SEBI officials as well as the BSc officials. However, they have alleged in the Bombay High Court that this is a case of time pass and frivolous applications and petitions being filed by the petitioner several times in an ordinary course of nature without any specifics being given.
And in continuation of its Hum Karke Dikhate Hai stories, the Adani Group has announced the launch of its latest film, Journey of Dreams, which highlights the transformative power of Adani Ports. This narrative-driven film pays tribute to the indomitable spirit of Hum Karke Dikhate Hai of today's India and Indians, showcasing unwavering determination. A statement from the group said that the film emphasizes how Adani Ports enables businesses, both large and small, to thrive by providing seamless connectivity and world-class facilities.
जहाज में बड़ी बड़ी चीजें जाते हैं ना पापा?
बड़े बड़े सपने भी जाते हैं।
ये क्या लोकल चीजें देख रहे हो? तुम्हारे लिए मैं अच्छे वाला लेके देती हूँ, हाँ? इंपोर्टेड वाला। चलो, आजा।
This is the shop I was telling you about.
Namaste. I love those. हाँ मैं पैक कर देता।
पूरा सुन तो लो भाई।
I need 10,000.
10,000 पीस अमेरिका भिजवाने। हो जाएगा ना?
हो जाएगा।
आपके बड़े बड़े सपने जा रहे हैं।
हम सिर्फ देश विदेश में व्यापार नहीं बढ़ाते हैं, सपनों को किनारे तक पहुंचाते हैं। अदानी, हम करके दिखाते हैं।
And President Donald Trump has paused military aid to Ukraine only days after the public clash with Ukrainian President Volodymyr Zelensky. The White House has issued a statement clarifying that the pause is to ensure a peaceful resolution. Tensions between Zelensky and Trump escalated due to differing opinions. Now, Trump, who has prioritized a quick resolution, criticized Zelensky's remark that ending Russia's war was still very, very far away. Meanwhile, Japan has deployed more than 2,000 firefighters to battle the country's biggest forest fire in 3 decades. At least one person has died in the blaze, which has torched more than 5,200 acres around the northern Japanese city of Ofunato. Around 2,000 people have already left the area to stay with friends or relatives, and more than 1,200 have been evacuated to shelters as per officials. More than 80 buildings are estimated to have been damaged so far, although Fire and Disaster Management Agency has noted that details are still being assessed. And it's 4 wickets down as the champion teams meet again today in a knockout match as India plays Australia in the ICC Champions semi-final. Last time the two big teams faced each other was at an ICC event at the World Cup final in 2023, where Australia defeated the men in blue, winning the World Cup. Relief for Indian fans as Travis Head's boundary-hitting streak is finally broken by Varun Chakravarti's spinning ball, which was caught by Shubman Gill. And that's all the time we've had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have
Thanks for tuning in to Talking Point Unfiltered. The idea of this podcast series is to try and get into the minds of our guests and understand how do they think about the current situation, be it business, be it markets, and what are the ramifications over the medium term and not necessarily what will happen tomorrow. Our guest today is Samit Vartak of Sage One. Samit, great having you. Thanks for taking the time out.
Absolutely my pleasure. So I think this is the first podcast I'm doing, so I'm looking forward to it.
Yeah, likewise, Samit. I mean, it's been the first time that we are talking on such a format as well, so really looking forward. So, Samit, there is no better time to talk about the market sentiment than when the market is at its worst, right? Because it probably gives you the best opportunities as well.
Yeah.
How do you see this current market environment? Because the unanimous calls that I get range from how it is prudent to not be invested in India currently. Yeah. If you want to be invested, then look at only the large caps. Don't look at the mid caps and the small caps, and keep a certain percentage of your portfolio in cash. There is almost nobody saying that start hunting actively in the mid cap and the small cap space, or that take an oversized bet out there in that bucket. How do you think about the situation?
Yeah, I mean, it's always good to have too many worries around you. That's where you find value, right? So I think after a long time, at least you're finding exciting opportunities. It's not the universe which has become cheap, but surely, if you're a stock picker, you don't need the universe to be cheap. At least there are so many companies in this kind of a market, which are trading at like 15, 20 times kind of a multiple, which were not available. I mean, what happens is that in this kind of a market, which is more driven by liquidity, when it comes down, again, it's because of the liquidity, right? That some people are forced to exit, some just take allocation decisions at these kind of times. And it's an extremely consensus call these days that you allocate to large caps if you want to be in India and get out of mid and small cap kind of space. So when liquidity comes out, good, bad, doesn't matter. Everything falls. It's just a matter of liquidity. And there's so much money which had gone into this space that when things come out, in this kind of times, when there are so many alarming calls, who is going to be buying at this point? So there are very few buyers, a lot of sellers. Some are not getting out because they probably don't have liquidity to get out. Right? So I think these are the times when you get this opportunity. And so I look at it as a cyclical, it's like almost like an annual sale. Or sometimes there is one big sale which happens every 3 years or 2.5, 4 years. That's a very, very common timeline when there is a big sale which happens.
Is that sale, you think?
I think so. This is definitely, last correction we had started in December 21 and it continued sort of towards 22, probably half of the year. And then 3 years down the line, again, September 24 is when we had the peak in the market. So we're already there, 5-6 months. And generally, I've seen that the average duration of correction is that 6 to 9 months. Right? And the faster it corrects, the shorter is the duration.
Right.
So this time, I think the speed was pretty slow, but then last 1 month, the speed has just accelerated. Right, so there has been a sharp correction which has happened, and again I think we need to remind ourselves that you will never get such a big sale unless there are warning signs around you. So I feel happy if there are too many people warning against it. That means that the weak hands can't withstand such warnings. Only the strong hands will withstand these kind of bombardment of warnings, not just from Indian investors, but also what's happening geopolitically. So I don't know what will happen in the next 3 months or 4 months, but I'm pretty sure if you are a good stock picker from a 3-year perspective, there is exciting opportunities, and it will be shocking to me if you can't make money over a 3 to 4 year period, reasonably above average kind of returns from the kind of valuations which are available in some of the select good quality companies. Right? And again, I think, I put up one analysis on Twitter which is comparing large cap, mid caps and small caps, right? And I'm comparing more of large cap and small caps, where I divided the universe into 3 buckets. One is PSU companies, right? Then the private banks, because PSU companies and private banks trade at very different multiples, right? And then you have the rest of the universe, right? Large caps, when they say, large caps are trading at 19 times forward or, 21, 22 times kind of backward looking, is mainly because of the mix of the large caps. 1/3 of the profits in large caps come in from the PSU basket, which trades at 8, 10 times kind of a multiple, right? And then when you look at the private banks, which make up for about 17% more, so 50% total, again, they also trade at that 15, 17 kind of multiple. And then you have rest of the bucket, which is trading today at 40 plus multiple.
Interesting.
These are median valuations of, so then you compare that with the small caps, right? There is very little PSU as well as private bank contribution from these. The both put together probably will be 15%, right? So then you look at the mix, right? And then you have the 85% bucket, which is trading at 30, 32 times kind of multiple compared to 40 plus in the large cap. That's the real comparison. You can't just compare a mix of bucket, which has all quality, but if the low quality is high in a certain bucket, overall you will feel that the valuations are low, but that's not really. I mean, how many portfolios have 33% allocation to PSUs?
So effectively you're saying that if you don't want to buy PSUs and if you don't want to buy private sector banks, then the large caps is probably more expensive than the median small cap.
Absolutely. Just look at all the companies. Just remove those 2 buckets, which are always cheap. You can't look at them from a P multiple, because for a 10 times P multiple in a PSU can be also expensive.
Right.
When they trade on an average 5 to 6 times multiple.
Now, for a lot of people who may ask listeners and viewers that there should be actionable points in a conversation, I think the last answer gone by is truly the most actionable point. You don't need anything else. You get some of the key points, screen for yourself, do a little bit of research, and you will get the answers yourself. You actually won't need to watch the rest of the show also if you want. But I think, Samit, thank you so much. That was very well explained. Now, I want to get to the mental aspect of it before I also nail it down to whether you find a confluence of all of these factors in the markets currently and what are those pockets maybe. But just one mental aspect that I want to get out here. You would be owning some small caps which would have seen a drawdown in this last 2-3 months, right? Some maybe 20%, some maybe 30, some maybe 50, what have you, right? How do you decide where is it that you get out of? And how do you decide, can I let me stay put? Because when it falls 30, 40, 50%, you are scared obviously about whether the story is gone wrong or is it just a valuation correction or everything is going down. So how do you decide?
Yeah, so I think one of the big mental reset that one needs to do at this point in time is detach yourself from the existing portfolio. Think as if I am restarting, building a portfolio. I have new money, I need to build up a portfolio now. And see what kind of decisions will you take then, right? Unfortunately, what happens is that because of the baggage of, you having taken maybe wrong decisions, or just because of market, fall, things have corrected, you get clouded by a lot of those decision, confusing facts, right? So once you remove that, build your completely new portfolio and then see, is it the same as what you have now? If there is a big difference, just change that. Just make that transition, because after all, your returns going forward will be based on today's valuation, based on today's optimal portfolio. And you need to build the optimal portfolio now without the baggage of having your old portfolio.
But it's an easier said than done thing. Are you able to do it?
I mean, it's just that you need, see, sometimes fund managers do have restrictions of getting out. Sometimes you just can't get out, right? Because by getting out, you probably will have 10% more fall or 15% more fall in the stock, right? So that becomes a hurdle. But for most of the investors, that's not a hurdle at all, right? So it's much easier for, a retail investor to do this adjustment, right? But at any point in time, even as a fund manager, I need to think, my portfolio is what it is, right? There will be some companies which maybe were highly valued. I may not be comfortable. I really love the businesses, but I don't like the valuation. A lot of those companies actually have come back to a very comfortable valuation. So you may have cash or may not have cash. The cash decisions would be very different. You may go for attractive, but I think you need to think about the same thing even here, that you think that whatever you have in your portfolio is an opportunity cost for you, right? You can easily replace that with something that you like, So if something else which is outside of your portfolio is much more attractive, you replace it. This is a time to swap. First of all, if you're in loss, this is a time where you can book losses, save paying taxes, and at the same time get something which is really attractive. So if you're aware of this fact, at least you will consider these factors for decision making, and it would help, because most investors would have lost value in their portfolio. They may not have cash, right? And it's easier for people who were lucky enough to keep cash. But don't bog yourself down with that. Whatever is in your hand, make the best optimal portfolio out of it, and then you'll be shocked. This can continue for sometimes 8 months, 9 months, sometimes a year, 2 years. But when things rebound, you will make up for not only the lost, portfolio value, but even make up really good returns in a matter of 4 or 5 months. It has happened multiple times. I mean, during 2009 fall, small caps had fallen by 70%. And in the next 14 months, the markets were up, the small cap was up 3.5x. That means they recovered entire fall. I mean, such a massive fall. This time it's, the fall is like 1/3 of that.
Yeah, exactly.
Right, 1/3. So it doesn't take much time to recover. But more importantly, make sure that the companies you have are the ones which will recover, because there will be many companies, in your portfolio, which may be a lot of story stocks, which would be much more cyclical, where there was a story, and many of the time in the long run do not do well. But, like I had made a presentation of how cyclical companies, in post-COVID, in the next 4 years, on an average, have gone up 10x. Whereas good quality companies have gone up less than 2x during those 4 years. There is a huge gap. Now, if you expect that these cyclical companies will continue to, if they have fallen by 50%, they'll quickly recover, that's like living in a fool's paradise.
So you believe that change will happen now?
That change will happen. But make sure that the portfolio that you have now is made out of companies which are longer term structural stories, where valuation has become really attractive. Forget about the fall in your existing stocks. Some of them will never recover. The breadth of this rise was so large that many of those stocks, I would say, sometimes 70-80% of the stocks will never see the recent highs in many years to come. But if you are just looking for 15-20 stocks, make sure that whatever stocks you have in your portfolio, have that high probability that they will, in 5 years, they'll be much higher than the peak that you saw in the recent past.
And the simplest yardstick is possibility of higher sales growth, right? Because that was one of the key things.
Possibly higher sales growth, as well as possibility of sustainable ROE.
Both.
Because cyclical companies will not have sustainable ROEs. And they will have, generally cyclical ROE.
So you would have played cyclical companies from 21 to 24 if you had played, but you are also out of them. You are now going for the sustainable ROE businesses.
Yeah, I mean, see, one-off you can take a tactical opportunity, but majority of your portfolio, generally should not be. It's a high risk, high reward kind of a game. What we look for is high risk adjusted returns. That's more important.
Got it. So where do you find these pockets now, Samit? And by cyclicals, correct me if I'm wrong, but you are therefore effectively ruling out commodity plays or what else gets ruled out? Let's first eliminate that, according to you.
Yeah, see, highly cyclical companies. For example, what I mean by cyclical companies is, let's take, for an example, railways companies. I had put up some analysis, a year back, on some of the PSU companies, railways companies, how they had gone up, and their valuation multiples had multiplied 5x, 10x. Valuation multiples, not stocks. Valuation multiples, right? So these are the companies where what they sell, their replacement cycle is really long. Sometimes 25, 30 years, right? So you will have great growth for 3 years, 4 years, because government is aggressively going for capex. Right? So then you will have a huge order book which build up. But who knows? Government can completely swap. They will completely reverse their decision of spending on a railway kind of a play and focus on something else, like suddenly. And then suddenly you will see that the order book has vanished, or it just staying flat, or going down slowly. And then no one wants to pay any valuation to these companies.
But so you are, sorry, just to interrupt here, but in a lot of these companies, the order books are still high. You believe the fortunes ahead will not be a factor of order book execution, but order continuation of order wins.
Exactly. There also has to be growth in order book, right?
Growth in order book also.
What P multiple, see, a lot of these highly cyclical companies generally trade at single digit multiples in the long run. PSUs also trade at single digit multiple because of that uncertainty. Generally they only have one customer. Railways also many times have one customer, and then the product replacement cycle is very long. That makes it more riskier. Plus they have huge fixed cost. So if you, during a bull market, go for too much of an expansion, raise too much of QIP money, when the things slow down, at that time your utilization goes down, fixed costs remain, and your margin just collapse. At that time, people go back, with low margin and low multiple. So the double whammy is huge, right? If your multiples from single digits had gone to as high as 40 times or 50 times, right? Add that to at the highest order book or the highest margins, that's one of the most riskiest things that you invest in. Because there is a risk to the valuation multiple as well as to the P multiple and as well as the growth. So that's what one needs to be careful. Are your companies, were they the ones where the valuation multiple went up too much? I'm pretty sure they will revert back towards the mean. Are their valuation really away from their long-term mean? Are their margins towards the higher end? Are those based on really, huge order books, but is their product replacement cycle really, really long?
Got it.
If it's short, doesn't matter. Then you can, those are much more resilient businesses. And whether your cost structure and expansion was too high, and are you ready for the slowdown? If the slowdown comes in and you're sitting on a huge cost structure, it becomes pretty risky.
Does the same hold true for defense? The reason I ask is, for example, shipbuilding. we were talking to Garden Reach shipbuilders.
Yeah.
But that management, so the book-to-bill ratio must be maybe 5x or 6x.
Sure.
But while their order book is 23,000-24,000 crores, I'm using that as an example, by the way.
Sure.
The management said that they expect that their order backlog or order book by the end of FY26 could be 40,000 crores from 25. And they believe that orders worth 180,000 crores would come in over the next 2-3 years, of which they will get mid-teens to high-teens kind of orders. So they expect order inflow.
Okay.
Their valuations have come off because all defense stocks have come down.
Yeah.
And their execution table looks solid. So does defense look similar like railways, or is that slightly different, you reckon?
No.
I'm asking this because a lot of people are invested in defense names.
No. It could be very different. See, again, I would go back to the stock picking. It should be bottoms up. In an rising tide, all the companies in any sector goes up. Number of companies in those sector also go up, right? Unfortunately, 10 years down, if you look at the 10-year, long-term perspective, there will be few winners. There is no question about it.
That's true.
Question is, are you in those? If you're invested in the entire basket, I'm pretty sure that basket is not going to work. Not going to deliver. Right?
But so, if the tide goes down, Samit, then will a good company also go down, or can a good company shine in a bad sector as well?
In the short run, it will also go down.
Okay.
In the short run, there is no like what happens in the upside, there is very little discrimination because it goes up because of the liquidity. In the short run, liquidity is what will take everything down.
Got it.
And that's where you get the opportunity to pick the right stocks. You look at examples of longer term companies, right? So for example, say APL Apollo, steel cycle has gone nowhere, but in the last 10 years, look at their profit, profit delivery. Look at their debt levels, what has happened. it's independent of the entire sector doing that well. Towards the end, and everyone gets funding and everyone starts doing well. But if you look at the next 10 years, one or two of those companies will be the winners.
Got it.
There won't be 10 players who would be the winners. So accordingly, I mean, you look at, in agrochemical companies like PI Industries, in consumer finance companies like Bajaj Finance or Chola, there will be only one or two winners. The rest will be below average, returns. And that's where you need to make sure whatever you are in are those winners. Think only from that longer term perspective, because most of the companies who went through upside where the promoters were taking advantage of frothy times, they went for multiple QIPs. They really don't have a real genuine long-term plan. They are making plans because now they are getting free money almost, and then they are deploying that money for expansion. But every expansion done at below ROE of what the investors return on investment requirement is destroying value, not growing value. Right. Any investment that goes which is above your return on investment, that's the only which adds market value, otherwise destroying market value. But during bad times, until that delivery really happens, there is a big gap of 2-3 years, because they're going through capex and people get excited and they think that it's going to add as much gross block, their market cap also is going to go up that much. And unfortunately, it doesn't happen. It happens for only one or two companies. And it happens across many sectors. So there will be multiple winners in this. There will be multiple winners in defense. There will be, in the renewable energy. There will be across a lot of cyclical companies too. But only bottoms up will work.
My final question, Samit, and that is on the futuristic themes, because now we're starting to see them making their presence felt. New age companies or any few. By the way, I don't just mean tech players. I mean anything which is futuristic in nature and coming up. But use that as an example that we now have, or we will now have one tech company or a consumer tech company being a part of the index. And a lot of people believe that what's happened in the West, wherein the consumer tech essentially became a large portion of the index as well, because the profit pools are growing. So from the futuristic themes, where is it that you are the most constructive? Here, you may have a view which is maybe 5-10 years out.
So I'm not that good at picking these futuristic themes, especially ones where they're not really making good profits, not making reasonable ROE, ROCs. As I said, I would like to pick companies which are high ROE already, where my evaluation whether they are sustainable, are they going to go through that 20% kind of growth, and I need little more certainty. Then I'm pretty sure out of these packs of new age, there will be winners.
But that's not the pond that you're fishing in.
I don't have the ability to pick those right ones.
Okay, so then let me reverse the question, since I mentioned last question. So what would be the top 1 or 2 bets or top 2 or 3 bets in the portfolio? You may not choose to take names, but you could give an indication of what kind of businesses are there, what sectors do they belong in? Because I'm guessing now your portfolio is primed for the next 2-3 years, because you would have made changes, etc. So what are the top overweights?
Sure. So see, there are certain themes where I'm getting bullish again just because of the valuation correction. There has been a huge time correction which these guys have gone through, and some of the themes which I like, one is secured finance, secured lending. So whether it's gold finance, and again there is one player who has significantly outperformed any other player in this, and where the gold prices have gone up by almost 40%, in rupee terms probably even more, so there is a huge sort of collateral that has developed where you still have the potential to grow. So secured lending, it could also be some of the home finance players which are going at 25%. You can see that their gross NPAs are still at 1% and the valuations have halved. So there are really good opportunities in maybe the smaller ticket size, home finance companies where they have pretty good risk evaluation, processes, right? Other area is, which I've been always, bullish on, are things like fabrication pipes, where we do keep on changing the tactical allocation. It went through, at one point we had say allocation of 10% plus. When things slowed down, when the valuations went up, maybe we didn't think it was worth to completely exit it. but to reduce the allocation. So probably we took it to the lower end. But now if you see, there is a huge benefit to these players, mainly because of these patra players or the scrap converters. The price difference between, say, HR coil, newly manufactured HR coil, and these converted from scrap is barely 1 or 2 rupees. Right? So there is a big market for these guys to capture from unorganized, because why would anyone want to buy? So a lot of these players may completely go out of business because they don't have too much of sustainable power. They could, if they can't really sell much and make profits, in a year or year and a half they go out of business and generally don't come back. So there is a big market for these guys to capture, even if at a total level there is not much growth. Again, I'm positive on the power finance, I'm positive on the luxury real estate, but these are again not sectoral bets that
these are all bottom up.
These are all completely bottoms up, and that's how the sectors sort of build up. You need to make, because the winners can come in from spaces which may not be at a sector level growing, but it could be that in a tough market sometimes the weaker players just go out of business, and then the strong players still can grow at 20% plus, right? So that's what you want. That it's very difficult to bring in, because sometimes when the sector becomes too profitable, there are a lot of players who want to come into it. So you may get really good sort of feel from a demand side, but then supply can suddenly come up, and it just they destroy the economics of the entire sector. That's what is more important. I think the demand supply gap is most important. Demand is easier to predict, supply is very difficult to predict, because you don't know where and how quick the supply will come from. And if you have more confidence about that gap remaining, even if the sector is slow growth, but if someone is taking away more market share, I think it's better to bet on that. Market share gain, I think, is one of the most resilient factor for sustaining ROE as well as resilient growth, because those players tend to grow during ups and down cycles. Whereas if you're just betting on sector play, you're completely riding the bull cycle of that sector. And if you get that bull cycle wrong,
then
if there is too much capex which goes on, it can destroy your returns. You may make money in the short run when things are just evolving, but when things stabilize, at that time you could go through big drawdowns.
Great. Samit Vartak, so good talking to you. Thank you so much for appearing on Talking Point Unfiltered. Really appreciate your time today.
Thank you so much, Neeraj.
Yeah. And viewers, thanks for tuning in.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We're going to talk about mid-cap and small-cap mutual funds today, because there's so much chatter about how the broader end of the equity market has performed over the last 5 months in this sell-off that the Indian equity market has had to bear. And that has undoubtedly had a bearing on your
portfolios as well. Some of you would have invested predominantly in small cap equity mutual funds based on the data that we've been seeing. Hopefully that isn't the case. Hopefully you've got a diversified portfolio. But if you've been a little more aggressive and you've got a longer term time horizon, then you might just have allocated more money towards the small and mid cap space. How do you correct some of these imbalances? We'll talk about that as well as certain data points that have emerged about the allocation that fund managers themselves are doing in the small and mid cap space. Join me to talk about this